we understand now that there are several factors that affect pricing. Firm factors, market factors, product factors. Let's discuss strategies to approach these different factors and mitigate them by talking about pricing strategies. Pricing strategies, I like to start with a famous Harvard professor, still around, Porter. Porter's generic strategies. You should start looking from here. Porter's generic strategies that affect pricing by looking at competitive scope and competitive advantage. Let's think about it. Do we want to be a cost leader where we have a large consumer base and we give them the best costs or the best price in town, so we're the lowest cost leader? Or do we want a broad market but stand out somehow? So we do a differentiation approach where we stand out from other low price competitors like Walmart versus Target. Target's slightly different. Or do we want a narrow target, a narrow competitive scope where our cost is low? We have a cost focused strategy. You come to IKEA versus Ashley Furniture. Or do you want a differentiation and a narrow target where you do a differentiation focus, where you're good at one specific thing? This is my area. Like, say, for example, if I want to stand out amongst all the competitors in airlines, where all of them are fighting for cost leadership and cost leadership and broad targets, some airlines, for example, like Qantas, focus on or Arab Emirates, focuses on a differentiation pricing strategy where they stand out and people are willing to pay that premium for that product because that's what they're good at. They are the best in class for first class and business class services. So that kind of is what you want to consider when you think of Porter. When you start thinking, where do we want to be? Is it a big market, a lower cost? Do we want to stand out? Do we just want to make money and move on? You know, that's that Boston Consulting question. Is this just a cash cow or a star? So when you're looking at other strategies, we have market share pricing, pricing at a premium, pricing on a cost plus basis, or target pricing, or reverse engineering too is another way of looking at it. Market share pricing, for example, is you selling at a lower price to hopefully have the volume. You have the economies of scale that can be met. So Unilever, Procter & Gamble product lines can compete at that level because, you know, there's about big, massive sales. We can go to United States and look at our big laundry detergents, and we also can go to Costco and bigger containers of laundry detergent. But it's got millions of buyers. You go to India and they sell little laundry detergent packets, but they could sell those packets to hundreds of thousands of people a month. So very different reach, but yet they have the volume to make that margin. Then you have pricing on a cost plus basis, where you're setting the price at a given rate of return. We want to make sure we're making X, Y, and Z on our products. So this is limited to competition, where competition tends to be limited. I can focus on my rate of return. Sometimes these are regulated utilities where they have to price returns and cannot go above a certain rate of return because we want to protect the market and protect consumers, like energy. Pricing at a premium, obviously premium, you want to price higher than others. And you want to be a standout product. So if I'm buying the Porsche versus a Nissan, right? Those are two very different market buyers. JCPenney, for example, is different than a Bloomingdale's buyer. Target pricing is where we design a product around the target price. Or another one, reverse engineering. We revolve the price or the product around the consumer. For example, IKEA is famous for reverse engineering. Canon is famous for reverse engineering their portable printers. They start with the consumer. What do they want? Target pricing is another way to say, we want to do it at this price. We know our consumers yearn for it at this price. The market's telling us, consumers are telling us, and so we're going to have, that's our target price. Can we make a product that meets that need? If not, is it going to give us the rate of return that we want? So those are a couple ways to look at it. There are lots of pressures on pricing, that like standardization or uniform pricing, where foreign consumers and clients purchase products at the same price. Creates a hugely competitive market. We have the Big Mac index, so we could see that the price of a Big Mac in the United States is similar to the price of it in Germany or Russia, right? Because of purchasing power. And we have another way of looking at standardization of prices. The airline industry, it's very transparent, super competitive, so cost leadership becomes a bottom of the price pit, and it's not very sustainable. Pricing too low can kill your company, but also can get you in trouble. It's called dumping. Regulatory pricing, if the World Trade Organization finds that you are dumping products in a foreign market, the foreign market can levy fines on you or cost added fees to your selling of your product. Why is that important? I mentioned in the past and other stuff where there's this issue with dumping from the European Union from agricultural products that killed the foreign market that they were selling to. Farmers had no place to sell because they couldn't compete with the subsidies that had made those products abroad. So when you look at dumping, you're looking at product, you're ruining domestic markets. So how much do you want to have a free market versus how much you want to have a protected market? If you want to have an argument, it's right here at the dumping. Good example is Tom's shoes, giving out Tom's shoes to people. Are we serious here? Giving out Tom's shoes is hurting domestic sellers of shoes for those that do want a shoe. So, for example, there are ways to allocate cost strategies. So you have variable costs, the costs that change based on production. Your fixed costs is always the same. The amount of workers you have is variable, but your overhead at the corporation, a number of workers, stays the same. Prices for sourcing goods or raw goods for your product varies. So for example, you have to keep that in mind. So we have two strategies to look at then. We have variable cost pricing and full cost pricing. Well, we want to do variable cost pricing. In some cases that makes sense, because in foreign markets where a company is concerned about the margin or the cost of producing a good, then we're going to variable cost based on the cost it takes to get it from production to that shelf, into the hands of a consumer. And so if you're dealing with high production or variable production costs, tariffs and currency issues, or you're dealing with a lot of middlemen that will have added markups, you would have variable price. It's not suitable when a company has high fixed costs because you may not have a product that's competitive. For example, imagine this container, flask, and imagine if you have to get it to a final product to the market and its price is too high because of its fixed costs, nobody's going to buy it. And it's not a product that's special anyways. There's a lot of other sellers. So know if you can get the scale and the price down. Full cost pricing allows you to look at the view of that no one unit is really important. It's the totality of it. So the total fixed costs and all variable costs cover the whole thing. So how do we look at that? When I look at full cost pricing, I'm looking at the total production of costs, say it costs $1 million to produce, plus all the selling and administrative costs and transportation, plus the markups from the middle people or our own from the industry standard, divided by the number of units expected to sell. So you have your total amount of units, but not the total amount of units you expect to sell. You have to focus on the latter. Why? Because there's always going to be loss. In retail, for example, vendors expect between 10 and 20% of their products always returning. So the amount of sweaters I have to return back from my Bloomingdale's to the vendor who produced it matters, and there's a contract with that. So you want the expected units sold. And that gives you the idea of the full cost you should be charging. because it gives you a reality of what you're going to produce and what you're going to actually sell. And then from there, you can produce it. Also, you want to keep it easy. Even though I'm selling a product line that's size 28 jeans to 42 jeans, even though I can only, I know it costs a little more to produce a 42 size jean, not much more, why not average that across? And I think I have an example of that. Total cost pricing on the average of cost, even when you're doing variables. So I think you can do both, in my experience of seeing. Variable cost pricing is concerned about marginal increments and cost changes over a broad. So you want to compute that, I should have the calculation here, is based on the maximum number of units sold and the variable cost price itself divided by the minimum number of units sold, I think. Let me see, where's the calculation? It's not in here. I'll provide these examples in a separate deck so you guys can see it with the calculation. You should see that. Skimming versus penetration pricing. This is interesting. Skimming is a method in which you use a foreign market to reach their market. You see people, some nouveau riche or wealthy classes are insensitive to prices. So they're willing to pay a premium for it. I'm not talking about inelastic price issues like pharmaceuticals where people have to pay it. I'm talking about skimming premium pricing for those who are willing to pay for something that competitors can't keep up with. So you can maximize your profits. Penetration pricing is the opposite. So I go in skimming to a market. I'm saying I want a valuable product. It is the best. So if I have an iPhone versus a BlackBerry, right? And I'm going to a new market never been before, and we want to get these markets in there. We could premium price this because we know people want that product, and they don't care about the price. Low pricing policies to gain market share is penetration. So skimming is we just want to skim the surface. Penetration is we want to get in that market and grab shares. So we'll market lower than the competitors. And if it's below our costs, we have to be careful so we don't get fined for dumping. So you have to be careful with that. Well, when can we do kind of both? When are we skimming and penetrating the market? Well, what if we have a situation where the market's already saturated with our products and we're a premium product? Apple's a great example of this and got into a lot of trouble with its buyers or its customers when they sold a phone that didn't have expected sales at a price point, and then weeks later dropped the price. And people were upset. I just bought the phone and now you dropped it so low. And that's not fair to me. I paid even though you're taking advantage of my wanting to be a trendsetter. And so to combat the saturation of market, to get all levels of a saturated market, they now offer product lines. You have the iPhone 13 Pro Max. Not everybody wants to buy that, or can buy that, or should buy that. And you have the Pro, and then the regular iPhone 13, and an iPhone 12, and an iPhone SE for those who want a smaller, simpler phone. All very different price points so that Apple can compete across all consumer baselines. And that's one way you can manage a saturated market with a premium differentiation model that where Porter's comes into play. So keep that in mind. You have different calculations. There's a plethora of different calculations and price strategies. These are just a few, and I have to fix the one on variable pricing. And also keep in mind, where do you want to go with this? Do you want to be the standalone premium product people want, or you're known for, or do you want to be amongst all others and have the best pricing and get the biggest volumes? All depends on your strategic determination. Will affect pricing at this kind of level. So all of it's in play.